Ladies and gentlemen, if you own gold, listen carefully because what I'm about to tell you could change your financial future forever. The world is on the brink of an economic storm, and the US dollar is losing its power faster than most people realize. Gold isn't just a commodity, it's the ultimate insurance policy against the collapse that's coming. And right now you have a small window, mere weeks to prepare. If you think the value of your money is safe, you're living a fantasy. Most Americans, and frankly most investors around the world, have been lulled into a sense of security by a financial system that is built on faith and paper currency. But that faith is evaporating faster than most people realize. The dollar isn't what it used to be. It's being devalued right in front of our eyes, and the mechanisms driving that devaluation are both predictable and relentless. Every time the Federal Reserve prints more money, every time Congress piles on debt, and every time policymakers try to prop up the markets with artificial support, they are undermining the very foundation of the currency. And here's the thing, when the dollar falls, the consequences are real. Your savings, your retirement, accounts, the value of everything you've worked for, it all gets eaten away by inflation. That's why gold isn't just an investment, it's insurance. It's the only way to protect your wealth when the system that backs your money is inherently unstable. History has shown this time and time again. Fiat currencies, by definition, have no intrinsic value. They are promises, they are trust in the government to maintain their purchasing power. But governments have proven over and over that they cannot resist the temptation to inflate, to borrow, and to spend. Every major currency collapse in modern history has been preceded by excessive money printing and debt accumulation. Look at Zimbabwe, look at Weimar Germany, look at Venezuela, and today the United States is not immune. In fact, it is moving down the same path only on a much larger scale because the amount of debt, the size of the central bank balance sheet, and the scope of government intervention are unprecedented. If you hold your wealth in dollars, in paper investments, or even in bank deposits, you are taking on risk that you may not fully appreciate. Gold, however, operates outside of the system. It cannot be devalued by government policy. Its scarcity is built into its nature. That is why it has served as money for thousands of years. It is the ultimate hedge against the collapse of fiat currency. And make no mistake, this is not theoretical. The signals are everywhere. Inflation is not a temporary phenomenon. It is baked into the system. Commodity prices are climbing. Debt levels are exploding. Central banks are trapped, unable to raise rates without causing market chaos. The dollar is weakening, and the policies being pursued are accelerating that weakness. Meanwhile, the average investor continues to place their faith in assets that are in essence paper claims on an increasingly fragile financial system. Stocks, bonds, and even cryptocurrencies are tied in one way or another to confidence in fiat money. Gold, in contrast, exists outside of those promises. Its value is recognized globally, and it cannot be diluted by reckless monetary policy. That's why anyone who is serious about protecting their wealth must consider gold not as a speculative play, but as a fundamental hedge against what is coming. The psychological factor is also critical. People tend to underestimate the risk because they measure wealth in terms of nominal dollars, not real purchasing power. They look at a balance in a bank account and feel secure, ignoring that the ability of that balance to buy goods and services is declining every single day. Gold provides a reality check. It reminds us that wealth is not just numbers on a screen. Real wealth is tangible. Real wealth preserves purchasing power. Gold is the measure of value that cannot be manipulated by policymakers chasing short-term fixes. And when the dollar declines, the market will adjust in a very visible way. Gold will surge. Its price will reflect the erosion of faith in paper money, and those who have positioned themselves in gold will see their wealth preserved or even enhanced, while the unprepared scramble to catch up. Now, some will argue that gold does not produce income, that it doesn't pay dividends, or that it isn't as convenient as cash or stocks. That's true, but it misses the point entirely. Gold is not about income. It is about survival and preservation of wealth. In times of financial crisis, liquidity is king, but liquidity in dollars may be meaningless if the dollar itself has been devalued. Gold, on the other hand, is recognized everywhere. It has intrinsic value. It has maintained its purchasing power across centuries, across different political regimes, and through every financial crisis the world has experienced. You can't say that about any modern fiat currency. Finally, timing matters. The opportunity to position yourself in gold before the next wave of economic instability is limited. The longer you wait, the more your dollar-denominated wealth erodes and the higher gold's price climb. This is why action must be taken now, not later. Diversifying into gold, holding physical bullion outside of the banking system, and understanding its role in preserving real wealth is not optional. It's essential for those who recognize the warning signs. Gold provides a lifeboat in a sea of financial uncertainty. For those who ignore it, the consequences could be catastrophic. In short, gold is more than an investment. It is a hedge against the collapse of the currency system itself. It is a safeguard for your wealth, your family, and your future. In an era where money is being created at an unprecedented pace, understanding this principle is not just wise, it is necessary. Protect your purchasing power, protect your wealth, and most importantly, recognize that the system is not on your side. Gold is. The writing is on the wall. Anyone paying attention to the global economy can see that gold is on the verge of a dramatic surge. It's not a question of if, it's a question of when and how fast. The fundamentals are aligned in a way that we haven't seen in decades. Every central bank in the world is trapped in a cycle of low interest rates, massive debt, and relentless money printing. The consequences of these policies are predictable, and gold is about to reflect that reality in a very real, very powerful way. We're not talking about a slow climb over years. We're talking about a wave that could hit hard, and those who are unprepared will be left scrambling, while those positioned in gold see their wealth not just preserved, but dramatically enhanced. Start with the most obvious factor, inflation. Everyone knows that consumer prices have been rising, but what most people don't understand is that the official numbers often understate the true erosion of purchasing power. Governments manipulate indices, adjust formulas, and cherry-pick data, but gold doesn't lie. Gold responds to real-world economic conditions. It measures the decline of the dollar, and the dollar is losing value faster than most people realize. When central banks continue to print money to fund deficits, when fiscal authorities continue to borrow recklessly, the purchasing power of paper currency declines. Gold, by contrast, is finite. Its supply cannot be expanded at the whim of policymakers. That scarcity is what makes gold the ultimate counterbalance to inflation, and as inflationary pressures mount, gold's price inevitably rises. Next, consider the role of interest rates. For decades, ultra-low interest rates have propped up everything from real estate to equities, but rates are not low because the economy is healthy. They're low because governments and central banks are drowning in debt. Raising rates to control inflation is politically and financially toxic. So the moment rates rise significantly, the cost of servicing the national debt skyrockets and the whole financial system risks imploding. So central banks are effectively trapped. They are caught between a rock and a hard place, unable to allow real rates to rise without triggering a crisis. Gold benefits from this trap. When interest rates are low or negative in real terms, gold becomes far more attractive because holding it does not carry the same hidden costs as holding fiat money. Investors see the opportunity and they are moving into gold in anticipation of both inflation and currency weakness. Geopolitical risk is another critical driver. The world is more unstable than it has been in decades. Trade wars, conflicts in energy-rich regions, tensions between global powers, all of these create uncertainty. When uncertainty rises, investors seek safe haven assets. Gold has always been that safe haven. Unlike paper currencies, it cannot be frozen, seized, or manipulated. It does not rely on the creditworthiness of any government. When geopolitical events shake markets, gold rallies, and the geopolitical landscape today is as volatile as any period in modern history. That instability acts like gasoline on a fire for the price of gold. Investors are increasingly aware of this reality, and their actions are beginning to drive prices upward in anticipation of the coming crisis. Let's not forget the role of central banks themselves. Many central banks, especially outside the United States, are actively buying gold. They recognize the risk of holding large reserves in fiat currencies that are being devalued. China, Russia, and other nations are diversifying into gold, effectively signaling that they do not trust the dollar as the world's primary reserve currency. This institutional demand is significant because it comes from entities with enormous purchasing power, and their actions set the tone for global markets. When governments themselves begin hoarding gold, it creates a supply-demand imbalance that can send prices skyrocketing. The private sector often follows the lead of these institutional moves, amplifying the effect. Now consider the broader market psychology. Investors are finally waking up to the reality that the traditional system of paper wealth is fragile. Stock markets may appear strong, but they're propped up by cheap money and unsustainable debt. Bonds are yielding near zero or negative returns in real terms, and inflation threatens to eat away the value of cash and fixed income investments. In this environment, gold is no longer a niche investment. It's becoming a centerpiece of portfolio strategy. The anticipation of a surge feeds on itself. As more investors recognize the inevitable, more capital flows into gold, driving prices higher in a feedback loop. This is not speculative hype, it's a rational response to systemic risk. Finally, timing is crucial. The conditions are aligned, and the next surge in gold could happen very quickly. There may be weeks or months where the price remains relatively stable, lulling the unprepared into complacency, but that is deceptive. Once the market fully internalizes the risks we've discussed, currency devaluation, inflation, central bank traps, geopolitical instability, institutional accumulation, gold's price could spike sharply, far beyond what most investors expect. Those who wait too long will face higher prices and increased competition for limited physical gold. Early positioning is not just wise, it's essential. In short, gold is on the brink of a major surge driven by predictable economic forces, systemic financial risks, and rising global demand. This is not a speculative bubble. It is a rational market response to a financial world that is increasingly unstable. The dollar is weak, inflation is rising, interest rates are trapped, geopolitical uncertainty looms, and central banks are accumulating gold in significant quantities. Each of these factors alone would support higher prices, but together they create a perfect storm. For anyone who wants to protect their wealth and even capitalize on this inevitable surge, the time to act is now. Delay and you risk being left behind, forced to pay a much higher price later when the market finally catches up to reality. Gold is not just a safe haven, it is a necessity in an era of unprecedented financial instability. Time is the one resource that you cannot get back, and in the world of finance, timing can make the difference between preserving your wealth and watching it vanish before your eyes. Right now, we are at a critical moment. The signs are unmistakable. The dollar is weakening. Inflation continues to erode purchasing power. Central banks are trapped in a cycle of low interest rates, and endless money printing and geopolitical risks are escalating. All of these forces are converging, and they are creating a scenario where those who act too late will pay the price. This is not a distant warning, it's happening now, and the window to position yourself properly is closing fast. Weeks, not months, may separate those who protect their wealth from those who watch it dissolve. The clock is ticking, and every day of hesitation increases the risk. Most people fail to act because they underestimate both the speed and the magnitude of what is coming. They assume that the markets will correct slowly, that inflation will taper, or that policymakers can somehow fix the system without consequence. That is a dangerous assumption. The financial system is not linear, it is fragile. Small shocks can cascade into massive disruptions. History is full of examples. The 2008 financial crisis started with subprime mortgages in an obscure corner of the financial world, and within weeks it spread across the globe. Right now the risks are systemic, involving not just one sector, but the entire foundation of fiat currency and global debt. When these forces finally converge, the adjustments will be swift, dramatic, and unforgiving. Those who wait for more clarity are gambling with the most important thing they have, their wealth. The urgency is amplified by the very nature of gold. Unlike stocks or bonds, gold has a finite supply. You cannot create more at will. This means that once the market wakes up to the impending crisis, demand will surge and the price could spike sharply, leaving latecomers scrambling. Physical gold in particular is a finite resource, and acquiring it after the rush begins will be more expensive and more difficult. This is why timing is so critical. Waiting for the perfect moment is a trap. In financial markets, the perfect moment rarely comes. Those who act decisively today will secure their wealth at a more reasonable cost, while those who delay will pay a premium both in terms of price and opportunity lost. Consider also the broader macroeconomic environment. Debt levels in the United States and globally have reached historic highs. Central banks are desperate to keep interest rates low to service that debt. Yet low rates are fueling inflation and encouraging more borrowing. Fiscal policy is on autopilot with deficits ballooning and entitlement obligations increasing. The combination of excessive debt, low rates, and inflation is a ticking time bomb. Gold, which cannot be created or devalued by these policies, becomes increasingly attractive. But as more investors recognize this, competition for available gold will increase and the price will respond accordingly. The longer you wait, the higher that price climbs. That is why there is an inherent urgency, not just theoretical, but real and measurable, in taking action now. Human psychology adds another layer to this urgency. Most people are conditioned to trust the status quo. They see the stock market hovering near all-time highs. They hear reassurances from policymakers, and they assume that everything will continue as normal. That is exactly the mindset that leads to catastrophic losses when a crisis hits. By the time fear becomes widespread, by the time everyone realizes that the system is unstable, gold prices will have already surged. In other words, if you wait for the panic to become obvious, you are already too late. Those who recognize the danger early and act decisively are the ones who survive and thrive. There's also a lesson in liquidity. Right now, liquidity in paper assets may appear sufficient, but that is an illusion. Banks, markets, and governments can only maintain liquidity through artificial measures, including printing money and extending credit. When confidence in the system falters, that liquidity vanishes almost overnight. Gold, on the other hand, does not rely on anyone's promises. It is liquid in a different way, universally recognized, and intrinsically valuable and portable. But to take advantage of it, you must position yourself before the system begins to unravel. Delay means losing access to the safe haven at a reasonable cost. In financial terms, it's not just urgency, it's survival. Finally, consider the compounding effect of waiting. Inflation continues to erode the value of your savings daily. Every dollar held in cash, every paper asset tied to the weakening dollar is losing purchasing power. Gold, by contrast, preserves value. The longer you wait to allocate resources into gold, the more you lose in real terms. This is a subtle but powerful effect. Procrastination doesn't just delay gains, it ensures losses. Weeks matter, days matter, hours matter, and that is why action cannot be postponed. The market moves faster than most people realize, and by the time the broader population reacts, much of the advantage will have disappeared. In short, the financial system is at a critical juncture. The convergence of inflation, debt, low interest rates, and geopolitical risk creates a narrow window of opportunity. Gold is finite, recognized worldwide, and insulated from the policies that are devaluing paper wealth. To act is real, measurable, and growing with every passing day. Those who understand the risk and position themselves now will secure their wealth. Those who hesitate will face higher prices, reduced options, and potentially catastrophic losses. Time is not on your side. Weeks, not months, separate preparation from regret. There is no substitute for decisive action in the face of a systemic financial shift, and in this moment, action is everything. Understand the threats facing the financial system today? Then it's not enough to simply worry or predict. You need to take action, and you need to take action now. Many people assume that they can sit back and wait for the markets to correct themselves, or that the government will step in to prevent losses. That is a dangerous assumption. The reality is that policymakers are trapped, debt is exploding, and the value of fiat money is deteriorating rapidly. If you want to protect yourself, if you want to preserve your wealth, and even position yourself to benefit from the coming turmoil, there are clear steps you can take, steps that are actionable, practical, and effective. These aren't speculative tips, they are strategies grounded in fundamental economics, historical precedent, and the hard reality of what is happening in the world right now. First and foremost, you need to understand that not all assets are created equal. Stocks, bonds, and cash may appear to hold value, but they are ultimately tied to the dollar and the promises of governments and corporations that are themselves highly leveraged. These are paper claims on an inherently fragile system. Gold, by contrast, exists outside of that system. It is real money, it has intrinsic value. It cannot be printed, diluted, or manipulated by policymakers. The first step, therefore, is to allocate a meaningful portion of your portfolio to physical gold. I'm talking about gold bullion coins and other tangible forms, not just ETFs or paper claims. The difference matters because in a systemic crisis, paper assets may not be accessible or may lose value relative to real wealth. Physical gold stored safely outside of the banking system ensures that you hold wealth that cannot be confiscated or devalued. Diversification is also critical. Gold alone is not enough. You need to spread risk across multiple asset classes, particularly those that are less vulnerable to the collapse of fiat currency. Precious metals like silver can complement gold. Real assets such as farmland, rental property, or other tangible goods retain value even when paper wealth loses its purchasing power. The goal is to create a portfolio that is resilient in a wide range of economic scenarios, one that does not rely on the continued strength of the dollar or the stability of government policy. Diversification is insurance. It doesn't guarantee gains, but it protects you from catastrophic losses. Next, you must reduce exposure to high-risk paper assets. Stocks and bonds may seem attractive, especially in a market that has been artificially supported by cheap money, but their real value is declining as the dollar weakens and inflation accelerates. If you hold large positions in these assets, consider trimming your exposure and reallocating into real tangible assets. This isn't a matter of timing the market perfectly, it's a matter of risk management. In an environment where systemic instability is increasing, risk management is far more important than chasing returns. Protecting your capital now ensures that you have the resources to take advantage of opportunities when the markets inevitably adjust. Liquidity is another crucial consideration. You need access to resources that can be deployed quickly if the system begins to falter. This doesn't mean holding large sums of cash in the bank because cash is being devalued constantly by inflation. Instead, liquidity should be held in assets that are both accessible and resilient. Gold, silver, short-term tangible resources, and even foreign currencies in stable economies. These resources allow you decisively when opportunities arise or when protective measures are necessary. In a financial crisis, flexibility and readiness are as valuable as the assets themselves. Education and awareness are part of actionable strategy as well. Many investors make poor decisions not because they lack capital, but because they fail to understand the dynamics at play. Study the history of inflation, monetary policy, and currency collapses. Understand how debt, central bank actions, and fiscal policy interact to impact the purchasing power of money. Knowledge is power, and in turbulent times it is also protection. Being informed allows you to anticipate trends, make rational decisions, and avoid panic-driven mistakes that can erode wealth. Consider also geographic and institutional risk. Not all financial systems are created equal, and some jurisdictions are more stable than others. For investors in countries with unstable banking systems or high political risk, diversifying holdings into foreign assets, stable currencies, or offshore storage can add an additional layer of protection. You are not abandoning your country, you are simply acknowledging that financial risk is not contained by borders, and that protection sometimes requires thinking globally. This is particularly relevant for assets like gold, which can be stored safely and moved if necessary. Finally, don't underestimate the psychological aspect of action. Waiting for confirmation or perfect timing is a trap. Financial crises do not announce themselves politely. By the time everyone realizes a collapse is imminent, prices of protective assets like gold may have already surged, making entry much more expensive. Action now is about positioning yourself to survive and thrive, not chasing speculative gains. It's about making rational, informed decisions to protect real wealth in a world where paper wealth is increasingly fragile. Every day of hesitation increases exposure to risk, and every decision to act today increases your chances of preserving purchasing power and financial security. In summary, actionable strategy is simple: discipline. Allocate to physical gold, diversify into tangible assets, reduce exposure to high-risk paper assets, maintain liquidity in resilient forms, educate yourself on the macroeconomic landscape, consider geographic risk, and act decisively without delay. These steps are not just recommendations, they are essential measures for anyone who wants to protect themselves from the systemic risks that are growing every day. The financial world is entering a period of unprecedented instability. Those who prepare now will preserve wealth, maintain freedom of choice, and potentially profit from the correction that is coming. Those who ignore these realities will be left vulnerable, their purchasing power eroded, and their options severely limited. The time for action is now, and decisive action is the key to financial survival. So, I'm telling you right now, don't delay, take a hard look at your portfolio. Understand that in a world of artificial wealth, real money is scarce. Gold is that real money. Prepare yourself, buy wisely, and secure your future because in just a few weeks, the financial landscape will look completely different, and the price of gold will tell the story of who saw it coming and who didn't. Don't be left behind. Act now.